Hey, hi everyone. Okay, for those who are on Zoom, can you let me know in the chat box if you can hear me clearly and if you can see my screen and if everything is working fine? Okay, yes, you guys should be able to see everything should be working fine now. Okay, cool. I'm going to start today's webinar so we don't delay so much. Okay, hi everyone. Welcome to today's webinar brought to you by yes, thank you so much. I'm glad everything's working. Hi everyone, welcome to today's webinar brought to you by Vantage. I'm so sorry for the 10 minutes delay. I was having technical problems. We're having trouble getting set up on the Vantage app. Can you guys let me know again, once again, if everything is working fine? If you can hear me, you can see the screen, everything is good? Okay, cool. Thank you so much. Okay, so don't worry about the delay. I'm still going to be able to finish just the entire webinar within the time frame that we still have left. Okay. So, yeah, we're gonna be doing inflation waves from CPI data to trading setups today. Today's the 25th of November. It is 5:10 p.m. here in Singapore. I know you guys are tuning in from like everywhere. So usually you've got like South Africa, Australia, Singapore, Mexico. I remember the last time. So I know everyone is from everywhere. So hi, welcome to today's webinar. Okay, so to not waste more time because we've already skip a little. Let's go straight into the disclaimer and let's talk about. I will have to stay here for a minute or two so that you guys can read through the disclaimer, but basically, the disclaimer is a reminder that this webinar is purely for educational purposes. You guys should not take this webinar as any form of investment advice, any form of financial advice, of any form of signal to buy or sell. I mean, there's no way that I'm giving you a signal anyways, but the point is, please take today's webinar as educational and nothing else, okay? Don't take it as a sign for to get in, like, oh, that girl from that webinar said that to buy gold. No, okay? Please take everything as just data and then you decide what you want to do with that data. You implement it to your own trading style, into your own investment styles, or whatever it is, but don't take this as a signal screw. Okay, so I will have to stay here for a minute so you guys can read through. We'll continue in a minute or two. Okay, cool. I think that's enough time for everyone to read through the disclaimer. Let's just continue. So I'm going to introduce myself. My name is Cassandra. If you guys already don't already know me, you guys can call me Cass as well. Okay, I am an investment analyst at Everest Fortune Group. We are a research firm based in Singapore. So what we do is a lot of back testing, a lot of forecasting, a lot of like understanding where the markets are moving, and a lot of strategy testing as well. So we are very versed with the markets. On top of that, I am a prop trader as well. For those who don't know what prop trading means, it means that I have been funded by multiple companies to trade their funds. How did I get this funding? I pass all their tests actually. Usually the test requires you to do 10% profit within 30 trading days. So Not 30 trading days, 22 trading days in 30 days, but the weekends are not really counted, so it's 22 trading days. So far, 10% a month for me isn't that hard to do. How do I usually do it? I use technical analysis, and now I also combine a lot of like fundamental analysis and a lot of what I'm sharing with you guys nowadays. Okay. Um, Once again, Everest Watching Group, the research firm that I am from, has been recognized as the finalist for the best Forex and best equity research for multiple years running. The whole point of me sharing all of this with you guys is so that you know that you're in good hands. You can ask me anything, and I will try my best to guide you and answer your questions to the best of my ability. Obviously, sometimes if you ask me something and I sometimes I may not be able to answer it because nobody can master the markets fully, but if I have the answer, I will definitely help you guys out. It doesn't even have to be related to today's topic. You can ask me anything you guys want to ask me, just anything regarding trading or investing, and I will still try my best to answer you. Okay, our agenda for today, we're going to look at why inflation data, CPI, PPI, PCI matters to traders, the Fed, ECB, and BOE, how central banks react to inflation, and inflation's impact on gold, USD, and equity indices. Okay, then we're gonna do some trading strategies around CPI releases day, like what you can do during those timing. Okay, so let's start with why inflation data, uh, more specifically CPI, PPI, and PCE matters to traders. Okay, all right, guys. Before we talk about trade setups or market reactions, we need to understand what inflation data actually represents. Because CPI and PPI and PCE are not just random numbers that show up on the calendar. Okay? These are the heartbeat, the pulse, and the DNA of the financial markets. If interest rates, the steering wheel, inflation is the engine. It tells you whether the economy is moving too fast or too slow or overheating to the point where the central bank needs to. Okay, so consumer price index, this is the best, the one that everyone knows, okay, is a very popular one. So CPI means the prices of things every day, like everything that people buy on a daily basis. Okay, so for example, food, housing, transportation, medical care, clothing, all the real world stuff. When CPI rises, it tells us consumers are paying more for the basic needs. This is the version of inflation the public feels most personally, but for traders, CPI is the only one of the biggest market movers because it tells us whether the Fed or ECB needs to raise rates, hold trades rates, or cut rates. Okay, a hot CPI reading can completely shake the US dollar, the gold, or equities, and even emerging market currencies within seconds because suddenly the entire market starts recalculating interest rate expectations. Then we have PPI, Producer Price, which stands for Producer Price Index. Okay, this one measures inflation at the business level. Okay, think of it like the upstream version of CPI. So PPI tells you how expensive it is for companies to produce goods. If PPI is rising faster than CPI, it means companies are absorbing costs, and eventually those costs will be passed down to consumers. Okay, that means CPI will rise later, so PPI can actually be a leading indicator for inflation. Traders who understand this often see inflation trends before the rest of the markets react. And finally, the big one, PCE, the Personal Consumption Expenditure Price Index. This is the Fed's favorite inflation gauge. Gaze. Sorry, I'm pronouncing it wrong. Gauge. Okay, so not CPI, not PPI. PCE is the one the Federal Reserve uses to make policy decisions, especially core PCE, which strips out energy and food. Why? Because PCE covers a broader range of expenditures and adjust for changes in consumer behavior. When the Fed says we need inflation back at 2%, they're talking about PCE, not CPI. So if you want to trade USD properly, if you want to understand why gold suddenly spikes or why US indices tank, you need to watch PCE extremely closely. All three of these inflation matrix shape the market in different ways. So CPI hits the market immediately. It's like a shockwave. It's like a shockwave. So PPI acts as a warning sign. It tells you the direction of future inflation, and PCE tells you how the central bank will actually respond. If you're trading Forex, gold, equities, or even crypto, inflation data is not optional, it's mandatory. It's the foundation of market structure. So once you understand how inflation works, you understand why the market moves the way it does, and suddenly the chaos starts to make sense. Okay, so if you guys, by the way, guys, if you guys have any questions along the way, if you guys anything at all. You don't even have to be shy. Just ask away in the chat box. If I see it, I will answer you. If I don't see it, I will try to scroll back later on. Okay. Why do I say if I see it? It's because for you guys on the Vantage app, you guys can see that there's more than 1,000 participants today, right? So, and you guys can see how the chat box is moving like crazy, right? So if you have a question, chances of me missing it is high. Okay, but for those who are on Zoom, you guys are good. I am fully able to see anything you guys are typing in the chat box. Okay, so let's continue with how inflation becomes the first domino that moves the entire market. So when inflation data comes out, whether it's CPI, PPI, or PCE, the number itself is not what moves the market. It is the chain reaction that begins immediately after. This is something many traders don't fully grasp. Inflation is really the first domino in a long line of market reactions. When inflation is high, the market instantly recalculates interest rate expectations. When inflation cools down, the market recalculates again. And because interest rates drive currency, bonds, gold, and equities, this one single number, a CPI release that takes half a second to read, can dictate the direction of an entire asset class for weeks. Think of it like this. Okay, inflation tells central banks whether the economy is overheating or slowing down. If CPI comes in too hot, okay, traders expect more rate hikes. If CPI comes in too weak, traders expect rate cuts. The markets don't wait for the Fed meeting. They price the expectations immediately. That's why sometimes the US dollar flies or crashes even before Powell opens his mouth. Okay, the market is forward looking. So when CPI prints above expectations, bond yields spike because traders think, okay, the Fed will have to tighten more. When yields rise, USD usually strengthens. And when USD strengthens, gold tends to drop because gold and USD move inversely. At the same time, equities fall because higher interest rates make borrowing more expensive and reduce earning potential. Okay, but it doesn't stop there. Inflation affects commodities too. High inflation means higher input costs, which impact company margins. The effect this really affects emerging markets, currencies, which are sensitive to USD strength. It affects crypto, yes, even Bitcoin, okay? Because liquidity becomes tighter when interest rate rises. This is the domino effect. So every time inflation data comes out, right, the entire market kind of recalibrates. This is why traders say CPI day is the real NFP day. Okay, it is one of the most important catalysts in the financial calendar because it literally dictates the behavior of global money flow. Once you understand this chain reaction, you stop seeing CPI as the number and start seeing it as the massive signal that flips sentiment across every market almost instantly. Okay, so let's move on to why markets react violently to tiny inflation surprises. One thing traders always find shocking is how insanely the market reacts even to a tiny inflation surprise. Sometimes CPI comes 0.1% hotter than expected, and suddenly gold drops $20. Okay, USD JPY jumps 150 pips and the S&P 500 plunges. And beginners wonder why such an overreaction. It's only 0.1%, but the market is not reacting to the number. The market is reacting to what the numbers mean for the future path of interest rates. If CPI prints even slightly above expectation, it tells traders the Fed's job isn't done. It means more rate hikes, or at least longer periods of high rates. And because trillions of dollars of assets are priced based on interest rate expectations, even a small deviation in inflation becomes a massive signal. Another reason market react too violently is because algos dominate inflation releases. Algorithmics Algorithms are programmed to scan headlines instantly and execute orders in milliseconds. Humans don't even see the numbers until the move has already happened. Okay, there's no way we're gonna beat AI. There's no way we're gonna beat the bots. Okay, so add to the fact that liquidity becomes extremely thin right before CPI, brokers widen spreads, institutions step back, markets makers reduce exposure, and you get exaggerated movements. Okay, so a 10 million order that normally moves the markets 10 or 3 pips, for example, suddenly moves it 50 pips simply because there's nobody on the other side. And here's something most beginners don't realize. Traders and institutions often pre-position ahead of major CPI releases. When the number confirms or contradicts those expectations, everyone rushes to unwind or flip positions. That's why CPI candles are always very brutal. Okay, they're a combination of thin liquidity, algo-driven reactions, position unwinding, and complete repricing of the interest rate outlook. It looks chaotic, but it's actually very logical once you understand what inflation represents. CPI is not just a data point, it's a verdict. It tells the market whether the central bank must tighten, pause, or pivot. And that verdict affects everything. Okay, it really affects everything. Okay, we're gonna move on to our next topic, which is the Fed, ECB, BOE, and how central banks react to inflation. Again, if at any point of time you guys have any questions, don't be shy, just ask me in the chat box, okay? So when it comes to inflation, let's understand the ultimate trigger. When it comes to inflation, the Federal Reserve is the main character of the entire global market. Every trader in the world, whether you're trading gold, US dollars, indices, crypto, or even oil, indirectly trades the Fed. That's because the USD is the world's reserve currency and the US interest rates influence global liquidity. So when inflation rises in the US, the Feds react aggressively, but what's important is how they react. Most people think the Fed looks at CPI, but in reality, the Fed's preferred metric is core PCE, which smooths out volatility and reflects consumer spending behavior more accurately. So when inflation runs hot, the Fed's first instinct is to tighten financial conditions, raising interest rates, reducing liquidity, signaling a higher for longer stance. Each of these decisions strengthens the USD, weakens gold and precious equities, and sometimes even shakes emerging markets. But here's what most traders underestimate. It's not the rate hike itself that moves the USD, it's the Fed's forward guidance. When Powell says something like, we remain committed to bringing down inflation, our markets instantly interpret that as hawkish. It doesn't make matter whether the Fed hiked or paused. The tone and trajectory are what move trillions of dollars in the market. Okay, so another thing traders need to understand is that the Fed often tightens aggressively, not because inflation is high today, but because they fear inflation expectations drifting higher. If people are believing prices will keep rising, they change their behavior. Okay, and that inflation becomes self-fulfilling. So the Fed steps in early to kill inflation before it spirals. This dynamic is incredibly important for traders. Market price the future path of inflation, not the current price. This is why USD pairs, gold, and indices often react second after the Fed statement rather than the rate decision. It's the signaling, not the switch, that drives market behavior. Okay, so let's look at the ECB, late to move, slow to pivot, and always sensitive to energy prices. So the European Central Bank, which is ECB, okay, behaves very differently from the Fed. And this difference is one of the biggest drivers for EUR USD volatility. While the Fed is aggressively and proactive, the ECB is generally slower to react, more cautious and heavily influenced by political dynamics within the Eurozone. Inflation in Europe is unique because it tends to be more sensitive to energy prices, especially natural gas and oil, due to Europe's reliance on import. This means geopolitical shock, supply disruption, or energy price spikes can cause Eurozone inflation to surge even when consumer demand is weak. As a result, the ECB often finds itself in a difficult position. Inflation is high, but the economy is fragile. When inflation rises in the Eurozone, the ECB reacts by raising rates, but they typically do so more slowly than the Fed. Okay, and because currency strength is relative, the euro often weakens if Fed hikes faster or signals a more hawkish path. This is why traders must always look at rate differentials, not rate decisions in isolation. If both central banks hike but the Fed sounds more aggressive, the euro USD still falls. If ECB suddenly turns hawkish while the Fed softens, euro USD can rally even without immediate rate changes. Another key factor, the ECB also watches wage growth, fiscal policy from member states, and inflation dispersions across the region. So inflation in Germany may be high while inflation in Spain is low. This complicates ECB policies. Okay, because of this fragmentation, the ECB rarely takes bold actions unless absolutely necessary. Okay, that's why the EUR tends to move in reaction to Fed shifts more than ECB shifts. So for traders, understanding this dynamic is critical. The ECB moves slower, reacts later, and tries to avoid shocking markets, but they finally act, EUR volatility can be massive. Okay, so let's talk about the Bank of England and inflation fighting with a fragile economy behind it. Okay, let's understand this very deeply because I think the markets are changing. A lot of things are changing, and it's good to be informed. It's good to understand what's happening. Okay, so the Bank of England operates in one of the most challenging economic environments. The UK regularly experiences inflation that is stickier and more persistent than both the US and Euro. A lot of this comes from the UK reliance on imported goods, high housing costs, labor shortages, and structural economic issues. So when inflation rises in the UK, the Bank of England tends to sound extremely hawkish, but here's the twist. Okay, they usually cannot raise rates as aggressively as the Fed because the UK economy is much more fragile. Higher interest rates choke consumer spending, slow down housing activity, and reduce business investments quickly in the UK. That makes the Bank of England policy a balancing act. This creates a very unique trading dynamic for GBP pairs. The Bank of England often signals that it is ready to act or remains committed to fighting inflation, which strengthens the British pounds even before any hikes occur. Traders price in expectations aggressively, but if economic data later shows the UK economy weakening, the Bank of England may be forced to pivot or soften its tone, and the British pounds can unwind sharply. This is why the GBP USD, GBP JPY, and EUR GBP are often extremely volatile around inflation releases. Another thing to note is the Bank of England pays close attention to wage growth and core services inflation. These tend to be more persistent in the UK, meaning the British pound can stay supported longer than expected, even if the Bank of England pauses rate hikes. But the moment the Bank of England signals concerns about recession risk, even subtly, okay, the Bank of England causes the British pound to drop instantly. So when trading the pound, it's not just about inflation itself, it's about the tension between inflation control and economic survival. So the British pound is essentially a currency that reacts to tone, not just action, which makes the Bank of England commentary one of the biggest catalysts for intraday volatility as well. Okay, I'm gonna move on to our third topic for today, which is inflation's impact on gold, the US dollar, and equity indices. Okay, so when we talk about inflation, one of the biggest and the most immediate assets impacted is the US dollar. Okay, this is very common. The reason is simple. Inflation determines interest rates, and interest rates determine currency strength. When inflation rises in the US, the market instantly begins pricing in higher interest rates from the Federal Reserve. And because the US dollar is the world's reserve currency, even a small shift in Fed expectation affects global capital flows. More money rushes into the US because investors prefer currencies that offer higher yields. This is why sometimes the US dollar strengthens before the Fed even hikes. The market is forward moving. Okay, it is forward moving, it's also forward looking. Another thing people forget that is that the USD strength during inflationary periods isn't just about interest rates, it's about global demand for the dollar itself. When inflation rises and the Fed gets hawkish, bond yields also rise. Higher yields attract foreign investors who need the US dollar to buy those bonds. So US dollar demand increases naturally. On top of that, during times of uncertainty, investors view the US dollar as a safe haven asset because of the size and stability of the US economy. Okay, so you get this double impact. Inflation pushes up rates, and rates push up the US dollar. And uncertainty pushes up the US dollar. This is why the US dollar is often the strongest currency during inflationary spikes. Okay, it could be temporary, but it usually reacts the fastest. Okay, so I've got this from this website. Let's see the why gold loves fear but hates rising yield. So this is what happens every time there is a some kind of announcement, some kind of something happening. You can see gold spiking a lot. Okay, so yeah, it's good to keep track of the data that are being released so that you know when the volatility is happening, and it will help you get to your take profit or help you get to whatever it is you're trading faster. Okay, so gold's relationship with inflation is one of the most misunderstood topics in the market. Most beginners think inflation is high means gold will go up. Okay, but it doesn't work that way. Gold doesn't just respond to inflation, it responds to how inflation affects real yields, which are interest rates adjusting for inflation. So gold is a non-yielding asset, meaning that it doesn't pay interest. So when interest rates rises, gold becomes less attractive because holding gold comes with an opportunity cost. That's why during aggressive rate hikes, cycles, and even the inflation is high, gold can actually fall because rising yields make bond and cash more appealing. At the same time, gold loves fear. Okay, when inflation rises too quickly or central bank loses control, investors panic and flock to gold as a safe haven. This is why during moments of extreme uncertainty, gold can rally despite higher rates. Okay, the key is understanding which force is stronger, the fear or the yield. Real yield often dictates the long-term direction of gold. When real yields are falling or deeply negative, for example, gold tends to rally stronger because it becomes more attractive relative to fixed income assets. But when real yields rise, gold faces pressure. So when the trading gold, don't just look at inflation, look at inflation relative to interest rates, and always consider the emotional elements behind all of this and what actually moves the markets. It's always going to be fear. So that's one thing you always have to consider. Okay, let's talk about inflation and equity indices and why stocks struggle when prices rise. Okay, so as you guys know, inflation is one of the biggest threats to equity markets because it attacks company profits from multiple angles. Okay, first, inflation pushes up the cost of borrowing. When interest rates rise in response to inflation, it becomes more expensive for companies to take loans, refinance debt, and invest in future growth. This automatically reduces profitability. Second, inflation raises the cost of goods and services. Companies must either absorb the cost, which hurts margins, or pass them on to consumers, which can reduce demand. Neither outcome is good for earnings, and earnings are the lifeblood of equity indices like the S&P 500, for example, or the Nasdaq. So tech stocks are particularly vulnerable because their valuations are based heavily on future earning growth, which when interest rates rise, the value of those future earnings decreases in today's terms, which leads to valuation compression. This is why Nasdaq often reacts to most violently on CPI days. Tech thrives in low rate environments and suffers when rates surge. Meanwhile, consumers focused stocks struggles because inflation reduces purchasing power Okay, so when household pay more for essentials like food, fuel, and housing, they spend less on discretionary items. This slows down retail sales, reduces businesses' revenue, and ultimately weakens the overall stock markets. So the market also dislikes uncertainty, not just majority of people. Okay, so the inflation creates a lot of uncertainty. Traders have no idea how aggressive the central bank will get and how long high rates will last or how deep the economic slowdown might be. So equity often drop not just because inflation is high, but because the future becomes harder to predict. So in short, inflation suffocates stocks by weakening margins, slowing spending, and increasing costs, and tightening financial conditions. This is why inflation data is one of the most important catalysts for equity market volatility. Okay, so we're gonna go into our last topic for today. I did say that we will finish today's topic very quickly. So don't worry, once we're done, it will give us a bit of time to do a Q&A session, which we usually don't have time to do. So I'm actually kind of glad that we're finishing a bit earlier. Again, if you guys have any questions, ask me in the chat box. Don't be shy. I'm here to assist you guys. I'm here to help you guys become better in trading and more profitable. In the meantime, let me just check the Vantage app to see if there's any questions from you guys. Let me scroll up. Okay, this chat is moving like crazy. Chat is moving like crazy, so okay, I don't see any questions from you guys today. Again, I mean, it's totally understandable because today's topic is so straightforward. Yeah, it's very informational, very straightforward. So I can understand why there are no questions today. Okay, let's move on to our last topic for today, and then we will go into a Q&A session. If you guys have questions, ask me. It doesn't have to be about today's topic, as long as it's any questions, you don't have to be shy. You are behind the screen or behind a phone. Nobody knows who you are, so don't have to feel shy, okay? Okay, let's start with understanding CPI day liquidity and why the market behaves like a different animal during this period. Okay, so when it comes to CPI, the number one thing traders need to understand is that the market behaves completely differently during the hour before and after the release. Okay, I'm sure all of you or some of you have noticed this, okay? So liquidity disappears not because the market is broken, but because big players step aside. Institutions, banks, hedge funds, prop desks, none of them want to take unnecessary risk right before a major inflation print because they know the number can swing the market 100, 200, even 300 pips in seconds. So what happens? The liquidity dries up, spreads widen, and the price becomes extremely sensitive to even small orders. This is why you'll see weird spikes or ghost wicks in the minutes leading up to CPI. There's just no depth in the order book. Okay. At the same time, algorithms dominate CPI releases. As soon as the numbers drop, literally within microseconds, okay, headline scanning algos instantly buy or sell based on whether the number beats or miss expectations. Humans don't even get a chance to blink. That's why the first candle after CPI looks like an explosion. It's a combination of algos reacting instantly and traders aggressively repositioning based on new interest rate outlooks. On top of that, traders must remember that CPI is all about expectations. If the expected number is 3.2% and the actual prints at 3.3%, the market can explode simply because that tiny difference changes the forward path of interest rates. CPI is not just an economic number, it's a market reset switch. Okay, so when preparing for CPI, okay, let's look at the pre-setup strategies, how to position yourself before an explosion. So when preparing for CPI, the market mistakes traders make, the biggest mistake that I usually make, okay, is trying to predict the direction before the release. Okay, that's actually very dangerous. Okay, so this is a form of gambling and not trading. CPI can flip an entire market bias instantly. Have you seen when markets shoot up and then like few minutes later it just shoots down the other direction? Okay, it's super, super um scary and it's so fast. Okay, so trying to preempt the move is extremely risky unless the setup is absolutely perfect. So instead, what you should be doing before CPI is identifying your zones of interest, the levels where liquidity sits, the areas where stop loss clusters are located, and the zones where price might wick into before finding its real direction. These zones will become your roadmap once the chaos settles. So next, you want to observe intermarket signals. What is the dollar doing? What are yields doing? What is gold doing? What are the markets currently risk on, risk off ahead of the release? These give you clues about positioning. If the dollar is unusually strong because CPI before the CPI, it may mean the market is expecting a hot print. If yields are dropping rapidly, the market may be expecting a softer inflation number. But again, these are only clues, not directions. Your job pre-CPI is to gather context, not to guess. Finally, if you absolutely want to trade before CPI, the best setups are either extremely clear trend continuations or liquidity spreads near key levels. But position sizing must be small. Stops must be reasonable and expectations must be realistic. CPI can invalidate hours of technical analysis in seconds. So pre-CPI, your real job is preparation, not prediction. Okay, so let's go into our last slide and then we'll do our Q&A. Let's understand what to do after post CPI and the smart way to trade after the dust settles. So the real money on CPI day is almost always made after the release, not during the first spike. The initial reaction is unpredictable and dominates by algos and thin liquidity, which means most retail traders get slipped, stopped out, whipsawed, or emotionally wrecked if they try to jump in immediately. The smarter approach is to wait. Let the first 5 to 10, okay, not 10 minutes. I think 10 minutes is not enough. Maybe 10 to 15 minutes play out. Let the spread tighten, let the candle stop stretching, and let liquidity come back into the market. Once the dust settles, price will start forming structure again, and that structure is your golden opportunity to get it. So when you're looking for is a clean break in direction, CPI reveals the new fundamental bias for the market. If CPI comes in much hotter than expected, you see the US dollar forming a strong bullish trend after the initial spike. So if CPI comes in weaker, you'll see bonds rally, yields fall, and the US dollar weaken. Gold and indices will follow accordingly. Your job is not to catch the spike, your job is to catch the continuation after the spike. So the best post-CPI setup is the pullback entry. Price makes a huge spike, retraces into key zones like demand and or supply, and then gives you confirmation with structure. This is where institutions enter. They don't chase the spike, they enter on the retrace once the trend is clear. This is where you enter too. And because CPI resets the market's expectations for interest rates for at least a few weeks, and the moves after CPI can always last for days or even weeks. And this is why CPI is one of the most best trading opportunities each month. Not for catching the first candle, but for catching the trend that CPI creates. Okay, so I think, well, that brings us, well, to the end of our main session today on inflation. And I really hope this opened your eyes on how powerful CPI, PPI, and PCE truly are. A lot of traders underestimate inflation because they think it's just data on calendar. But once you understand how inflation reacts and affects interest rates, how interest rates affects currencies and equities, and how expectations affect yields, and how yields affect gold, you suddenly start seeing the entire financial markets as one big connected machine. So inflation isn't just something economists talk about, it's literally the heartbeat, okay, of the market. So if inflation rises, everything shifts. If inflation cools, everything shifts again. And because central banks respond aggressively to it, inflation becomes the number one force that shapes whether the US dollar strengthens, whether the gold breaks out, whether Nasdaq rallies, whether the euro collapses, and whether emerging markets survive or crash. So the most important takeaway from today is that inflation releases are not just numbers, they are the catalysts. They reset expectation, they reshape positions, and they create trends. They cause liquidity shocks. And if you understand how to read inflations, you're no longer reacting to the markets and you're anticipating the market's behavior with clarity. So remember, you don't have to trade the CPI the moment it drops. You have to be the hero during volatility. Okay, you don't have to be that hero. Okay, you don't need to gamble on the spike, and your edge often comes after the chaos when the structure forms and the trend becomes obvious. The real professionals don't trade the noise, they trade the outcome. So since we have a little bit of time left, well, not really, just a few more minutes left, I'm going to open up the floor to any Q&A to wrap up this session. Drop your questions in the chat box if you have anything to ask, anything about inflation, central banks, or how gold reacts, how to position around CPI days, and even your day-to-day trading decisions. So let's go through them together. I already see one question here, so if you guys have any more, just ask away in the chat box, okay? So why does the market react opposite to what the CPI number suggests? Okay. That's a very good question because markets, again, because the markets trade expectations, not the numbers. So even if the mass market already expected something to happen, but it ends up happening differently, it's still going to move the market. So if CPI is high, but the market was expecting even higher, the US dollar can drop and gold can rally. Okay, it's it's kind of like the bid you beat or you miss dynamic, not the raw reading that drives the move. How can I personally prepare for the CPI releases? Okay, again, other than not trying to predict the direction, I would map out liquidity zones. Okay, so what I mean by mapping out liquidity zones, I mean like marking out support and resistance levels. Observe DXY, which is the US dollar index, okay, and treasury yields is something you can also observe, and then let the spike happen. So I personally trade the post CPI structure, not the initial candle. So that's why I think it removes a lot of risk if you do post rather than pre. Okay. Okay, guys, I don't really see any more questions. If you do, just drop it right now. If not, thank you for joining our webinar today. I'm so happy to see you guys here. I will see you guys next week. there was 1,000 of you here. There weren't a lot of questions today, but I totally understand because today's topic is super duper straightforward. So I will see you guys again next week, same time, a different topic on economy, macroeconomy, microeconomy, geopolitical topics, fundamental analysis, basically anything that is not technical analysis because I covered that for you guys now. Do follow Vantage on Facebook, Instagram, X. I know it's a Twitter sign, but it's X now. LinkedIn and Telegram. You guys can get in touch if you guys need the video recording at any point of time or anything at all. Just email Vantage and let them know, and they will accommodate and assist you guys. Okay, so thanks guys for joining. I will see you guys in a week. I hope whatever I shared with you guys today brought you guys some kind of information or help you see the markets in a different perspective, which in turn will help you guys become better traders, hopefully. And not just better traders, but more importantly, profitable traders. Okay. So thanks, guys. Take care. I will see you guys in a week.